All right. Today is Sunday, 12th of May. This is a recap for the stock market activities this week and an outlook for the week to come. And folks, I got a good one for you tonight. Happy Mother's Day. Hopefully you got your mom to brunch today and you got reservation ready and you did not embarrass yourself in front of your mom. 30 years later, the guy is still a loser. Not a good look. But with that, folks, let's dive deep into tonight's discussion. What's up with utility stocks? You see, we've been tracking the consistency of outperformance by certain sectors. This is why we do the market performance segment in this show, which a lot of you skip. That's your loss, of course, because we have valuable discussions. What we do is we try to spot consistency in certain sectors' performances. Say in the month of March, for example, say all the way to midway in April, we spotted the consistency of energy stocks outperforming. So once in a while, you see technology coming back up, you see big rebounds, big pops in names like Nvidia or Amazon or Meta, name your name, in the mega cap technology stocks. But then they fade away, and the consistent theme has been energy. Then you go from midway April all the way till we are today. And we've been seeing utilities outperforming week after week after week in a consistent manner. And there is a message in this kind of overperformance. You see, a lot of you have been watching the program and let's just say not having your head up your ass in this economy. You can see that we are in a stagflation phenomenon. Inflation is still going higher, albeit being at a slower pace. That doesn't really help us either because our wages are not keeping up with the pace of inflation, even though it is rising at a slower pace. At the same time, we see weakness in the economy. We're talking about rates, the highest in years. We haven't seen rates like this in a very long time. And these higher rates, let's say they've been sticking with us for about 2 years or so since the Fed began raising rates in 22. They're beginning to show damage in the economy. Segments of the consumer beginning to fall apart. Segments of the economy beginning to fall apart. The combination of these dynamics of inflation persisting and weakness in the economy showing up because of higher rates is stagflationary. But of course, the Federal Reserve Chairman, Mr. Powell, has his head up his ass, and to be honest with you, he's not really in charge. Janet Yellen is, and Yellen has political conflicts. If the Biden administration loses the elections, Janet Yellen will lose her power. So of course Powell will come out and deny stagflation and play the political games, but he's not going to go as far as cutting rates because his own reputation is online. He's not going to cut rates until something bad starts to hit the economy. The question, of course, becomes, are we about to see a conflict between Powell and Yellen at some point? My hunch is no. Powell is really submissive to Yellen. She calls the shot, and that's a really interesting dynamic. But in this fiasco that we're seeing in the Fed and the Treasury, the market is also speaking. The market is seeing something, and it is screaming out loud. We see that utilities outperforming as of late, year to date. Utilities crushing the S&P 500, crushing XLF Financials, XLI Industrials, even XLK Technology. Utilities absolutely creaming technology for the year. It's only lagging the XLC, that's communication services, and it's heavily tilted by Alphabet and Meta, and the XLE Energy. And we talked about the phenomenon of the XLE Energy, that's the inflation part, and the XLU Utilities, the stag part, being the top two sectors in this market so far. XLC an exception because of the overweighting of Alphabet and Meta. But somehow the chairman of the Fed doesn't see the stag or the inflation. Now, the question becomes, we know that historically speaking, when XLU Utilities outperforms, it is usually a leading indicator for a recession, a slowdown in the economy, perhaps a bear market to come. Is this what we're seeing? What is the evidence behind that? But before we talk about all of this, you gotta understand that utility has been rallying year to date, outperforming pretty much every sector in the stock market right now. But all of a sudden, Johnny come lately, the so-called analysts, they come out right now, after the rally's already been going on, they come out and say, oh, utilities stocks are on fire. Here are the top picks. You got to buy utilities now. No. You got to be careful. When the so-called analysts, they come out of their holes and they begin talking positively about something, it's probably going to go down. Take, for example, this headline. It reads, Meta shares hit intraday record high after analyst says company has too many advantages to count. And that was exactly the top. And after that, Meta went down by double digits. With that being said, let's look at the historic relationship between XLU and the S&P 500. When the XLU outperforms the S&P, usually that leads as an indicator bad outcomes for the economy and the market. Here's a monthly chart, XLU by the SPX. If the chart is rallying higher, we know that the XLU utilities is outperforming the S&P. Well, gee, if we go back to the beginning of the century, the major outperformance that you see here, XLU over the SPX, when did that happen? The dot-com crash. And the outperformance of the XLU begins just before the crash. So the XLU actually began outperforming the SPX in the month of January of 2000. And that's about 2 months before the crash in the NASDAQ. Then you see in 2008 when the XLU outperformed the S&P 500 by a lot. That was preceding the financial crisis and the crash. Then we go to the third example in 2019 when the XLU outperformed the SPX. That was just before the COVID crash. And of course, beginning, let's say, November of 21, XLU utilities began outperforming the SPX, and that was the leading indicator that we're about to head into a bear market in 22. And now we're beginning to see the XLU outperforming the SPX. Too early to say, but noted. And the question now becomes, what is the XLU sounding the alarm about? What is the message here? Because it's not just the XLU outperforming the S&P that we've seen the last couple of weeks. We have seen commodities getting hit really hard, at least the ones that ran way too hard, such as cocoa and coffee. We have energy commodities going down. We have bond yields trending down, bonds going higher. We have gold, the ultimate safety. That's also been surging higher as of late. So it's not just utilities outperforming the S&P that we're worried about, that maybe there was an indicator of a recession to come in the economy. It is multiple layers of evidence that when we stitch it all together, you cannot really ignore this message. Let's look at the performance since the October bottom of last year. XLU, the candlestick chart. You have the Qs, the NASDAQ in light blue, and you have the SPX, the S&P 500 in orange. Since the bottom of last year, we see that the utilities sector is outperforming both the NASDAQ, technology heavy, and the S&P 500. Let's zoom in a little more. Since the April top, it's actually the late March top in the market so far. Since then, we see that the XLU is up about 8.5%. We see that the S&P and the Qs negative since then. Now, if we plug in Brent oil in red, you see that Brent oil is down about 6% since then. So now we're beginning to gather more evidence about, wait a minute, this could be a recession warning. If we plug in the XLP, which is also a really defensive sector, XLP, that's staples. Think about companies like Procter & Gamble, Walmart, PepsiCo, and the likes. We see that the XLP, since the top in late March, we see that the XLP is positive, but the S&P and the Qs are still negative. So we have two defensive sectors, risk-off sectors, leading the market as of late. Now, you might say, but what about financials, Maverick? If we have a recession warning, why are financials also outperforming? Well, let's clean up the chart a little bit and plug in the XLF. Financial sector in white. That's also negative. Don't be deceived here. They're all lagging utilities. Now, another argument you might have against all of this is, well, if it is a recession signal, Maverick, then the XLU should be outperforming along with the TLT. If there's a rush to safety, then folks are buying bonds too. And if you plug in the TLT since the late March, early April top, you'll notice that the TLT is actually negative. So it doesn't add up here. I actually say it does add up. If we go back in history and we study the relationship between the XLU and the TLT, we will see positive correlation in the majority of times. Why do we see that? Because the XLU is dividend heavy, and it thrives when dividend yields go down in bonds, meaning that bond pricing, the TLT, goes higher. So we see TLT and XLU going higher together and going down together most of the time. Yet when we have divergences, usually this is a warning sign. For example, if we go back and we see the last divergence that we got, it was back in 2018. You see the XLU moving higher, TLT trending down. What's up with that? The risk of the Fed hiking rates, all of the fiasco with Powell, he's going to normalize interest rates. He doesn't really care. He's just going to hike rates and autopilot policy. Stock market goes down by 20%. The guy backs off. One of the biggest mistakes in Federal Reserve history. But in the anticipation of that autopilot policy, we've seen yields going higher, so the TLT trending down, and the market found refuge in the XLU. In utilities, other stocks began trending down, risk-on stocks, technology, and the likes. But investors found refuge in the XLU, and hence we see the outperformance. Then the Fed backs off, and we see the XLU going down and the TLT going back up. Doesn't mean that the XLU has to go down after that, but it means that the hedging of buying the XLU and the XLU outperforming the S&P 500, that ends. That's all what it means. So in this example, it was a benign warning. If we go back to the other instance, when we see TLT and XLU diverging, where the XLU goes higher and the TLT trends down, we can find another example in late 2012, early 13, during the taper tantrum. When the XLU moved higher, TLT went down. The anticipation was that the Fed would begin to taper the policy, the easy policy that is, because of fear of inflation. Of course, that did not happen. Bernanke backed off, pussied out really, just like Powell in 2018. So again, in this case, it was a benign warning. But what we can extract from these two examples, investors flocked to the XLU before bonds in anticipation of something bad that's about to hit the economy and markets. And if we go back to an example before that, in the year 2008, you can see that the XLU and the candlestick pattern outperforming the chart in orange, the TLT, in the year 2008. And that was a warning sign that watch out. Investors are going to utilities because that's the last resort in the market. Consider it a recession warning, and once the recession actually hit and materialized, investors switched from the XLU to actual bonds, buying the TLT, because that's the last resort of safety. That's when you have Lehman, when you have the crash ongoing, when you have the recession already on. Investors rush to the safety of bonds, and later, after that, they switch to gold. And we see the XLU utilities going down along with the rest of the market. But what's important is the period before something bad happening. We see the XLU outperforming bonds. And this is what we see right now. XLU outperforming not just bonds, but also the stock market. Now, after studying all of these examples, I'll leave it up to you. What do you think? Is there a warning sign by utilities? Because we have a really pivotal week coming with the CPI, PPI, retail sales data, economic indicators, Philly manufacturing data, a lot of macro points to come. And they could prove that the XLU is just flashing a false alarm, or they could actually verify the alarm by the XLU. That doesn't mean that utilities will continue to outperform. We'll talk about that in a second, but you have to be objective here. I just gave you the picture and gave you where the XLU outperforms the S&P, where it outperforms bonds, and now you know. But you see a lot of the perma pumpers, and the majority of Wall Street, of course, is hyper bullish. But you got this headline, this time surging utility stocks are a danger to themselves, but not the wider market. And this is according to Fraudstart. Perma pumpers, even if there's a nuclear bomb in New York City and the New York stock market goes bust, there's no longer a stock market. They'll come out and say, you got to buy the dip. We'll make a fake stock market in the metaverse. You can buy the dip there. Now, I do agree with the fact that we could be seeing a short-term top in utilities. Matter of fact, I'm betting on it. But the message is really important. Fraudstart says that, it's just a benign signal. Don't worry about what utilities have been saying in the last month or so. I say, no, you got to worry about it. There is a message there. And for the message to play out, it doesn't mean that utilities has to continue to outperform, as you've seen in the case of 2008. With that perspective out of the way, the week that was, and I said, folks, before we even headed to the week, that I'm going to be light. I'm going to be traveling. I'm not going to be as involved as prior weeks because I view this week as boring, low volume, nothing burger kind of week. The only thing that we got, because of the lack of macro data, we got a bunch of Fed zombies opening their holes and saying a bunch of stuff. Now, we know that the Fed zombies are not in charge. They have no idea what they're doing, actually. And depending on the data, if we get lower inflation data, they come out and say, yeah, we're going to cut rates. Then you get hotter data because they talk financial conditions to loosen. And as a result, we see hotter inflation data. The Fed zombies come out and they say, yeah, we're going to cut rates, but maybe it's not going to be as soon as we anticipated. Maybe 25 will do it. And that was the game that the market loved. That sure, maybe rate cuts are not coming as soon as we anticipated or as frequent as we anticipated, but they're coming. It's just a matter of time. And we said that that's good for the market until the perspective and the narrative by the Fed zombies begins to shift toward rate hikes. And this week, we got an interesting early warning about the shift in narrative, not policy yet, but narrative by the Fed zombies. We got the demon from Minneapolis, Fed President Kashkari, who came out and said that he doesn't rule out a rate hike. Okay, now we're beginning to talk about it. If we get a hotter CPI, PPI this week, I think the narrative will go full blast. Forget about ruling out a rate hike. Kashkari will come out and say, we actually need a rate hike. That's the moment when we say rest in peace to the market. Of course, we cannot assume that CPI or PPI will come out hot and lead us to that, because we also have a recession signal coming out of utilities. For all you know, the CPI could be cooler. The question now becomes it's going to be cooler for the wrong reasons or the right ones. Nonetheless, it makes this upcoming week way more interesting than the week that was. And I know what you're going to say. You're going to say, but Maverick, what are you talking about? The week was pretty good. The market was going higher. All what you had to do is just buy some calls and boom, you made money. I got you. The S&P went higher. But if you look at the major stocks, Apple, Tesla, Nvidia, they were kind of flattish. There was no action in the big guys. The pop in the market was led by stocks like Raytheon, which I already own in my portfolio. So I don't see what the big deal about this week and all the bulls coming out of the woods all of a sudden. You got to be careful. It could be a trap, because we have a low volume week and we've done a significant recovery in the S&P 500 before the most important data, PPI, CPI, retail sales, and many more. Either the market knows that these data points will be favorable or it's a trap. And instead of looking at the S&P, when I say it was a boring week, it was a nothing burger week, I look at the bond market. And when we look at the 2-year yield, the daily chart you're looking at right now, you can see that Monday, Tuesday, Wednesday, Thursday, nothing really happened. We've been just consolidating in perhaps what you can call a bear flag pattern. Maybe it's an outlook that the CPI will come out cooler and we see the bear flag play out. Except, of course, comes Friday's session, we see the 2-year moving back up. Now, had the bear flag played out, or at least began to play out Friday, we would have said, okay, this week was a bullish confirmation. We go to the CPI next week, and higher we go, and bond yields go down. But the mixed messages at the end of the week that we received just illustrate that it was a week that you shouldn't have been as engaged as a lot of you have been, because there were a lot of traps. You got to gap up Monday, a little bit Tuesday, then you stalled Wednesday, Thursday. Comes Friday, a lot of folks waiting on the sidelines or having bearish positioning, they capitulate and they say, okay, I'm going to join the market now and bet to the upside. Next thing you know, we get a gap and crap Friday. So it was not the best week when we say pick your battles. With that being said, I think we played it pretty good as we can. So if you go back to the morning brief from last Friday, I gave you a bunch of bullish trades on the XHB, IYR, IWM, Qs, SPY. If you followed any of those, pretty much all of them played out. The exception is the XHB, depending on when you got into it. Still got time till May 17th, but to be honest with you, if you're sitting on profits on any of these trades that didn't expire yet, because we know that the Qs and the SPY already expired and both of them were profitable, but the other three, if you have them, I would book profits Monday, because you don't want to roll the dice before the PPI and the CPI. But the point being is these trades worked out and did beautifully. Of course, I did not follow them, but a lot of you did. Instead, I went with a straddle situation, buying VXX, this is a VIX proxy calls, in case we see the market dropping and volatility going higher, and then buying SQQ's puts, that's a bet on the Qs, the Nasdaq to go higher. And we got one of them playing out. The SQ's puts played out, gave us 40% profits, we booked that. On the other hand, we booked a loss on the VXX calls because volatility got absolutely creamed this week. But we also played the S&P 500 a little bit. Thursday, we gave you a morning brief, we gave you bearish indicators, confirmations, and bullish confirmations. Out of all of them, we got 2 bullish confirmations, the SPY and the E-mini futures, and we decided to go with that because we knew comes Thursday, Friday, the market maker would begin to get engaged, and the risk of 520, SPY 520, became really, really close. That the market maker will have to be squeezed since we have no volume for the week. Nobody's really betting that the market will go down, so we had to roll the dice and go with the 520 calls. That was the right call because if you look at the chart, here's Thursday, 5 minutes chart. You can see that the SPY went higher, but then the market maker, at least in an attempt, began dropping the SPY because they wanted to avoid 520 being in the money. But again, with no counter volume from the traders that can assist the market maker, and we actually see buying algorithms continue to buy against the market maker. And we go above 519 again. The message is clear. The market maker will look at this and say, all right, I guess they want to go higher. Let me buy some SPY shares and pay the 520 calls expiring that day. And we see it move higher all the way to 520. Comes Friday, we see a big gap higher. But one step at a time, folks. Because comes Friday, we did the opposite move. Here it is. Good morning. Today, we see momentum shifting as we begin strategizing for next week. I'm eyeing a few charts. The SPY, looking at the 1-hour continuous momentum of the MACD indicator, we can see that bullish momentum is running out of time before we see the bearish momentum taking over. Of course, the options open interest data is important in determining whether the market maker will get squeezed today to buy more shares, but assuming that won't be the case, we should see an attempt to push the tape back below 520. giving the upcoming change in momentum and the market maker's activities today. I will go with the trade for the 520 puts trading today or Monday's expiration. Here's the chart that we gave you. You can see in the MACD indicator that the momentum is about to shift from bullish to bearish. So again, when we take a trade, folks, you got to understand that we are in the risk management business. That's what trading is all about. And there is no guaranteed shot. Nobody's going to give you a sticky note in the morning, hey, buy this and that, and it's a guaranteed shot. You got to analyze the data, gather up the evidence, and take a shot. And also know when you got to cut loss in case your timing is wrong, your entry is wrong. But one step at a time. This was a good indicator that the odds say, along with the market maker data, that they want to make the 520 calls lose money by Friday's expiration, or at least scare some of them to close their positions at a loss. When you combine these two indicators, along with an elevated RSI on the hourly chart, you got to take a shot that we're going to pull back. And here's the update. Indeed, we got to pull back. Now we go back to the SPY's 5 minutes chart because a lot of you would say, but what is the confirmation that the trade is on? We look at the lead. The chart will give you some leads. And right off the gate upon the open, we got a tail candle. And the tail was 521.36. So the chart spoke and it told us that, wait a minute, this number is really important. You lose that, we got a problem. And we're using 5 minutes, so we're going to stick with the 5 minutes. We got a break. That was a warning. So if you've been waiting for a solid confirmation, and you didn't take the shot right off the gate, this could have been a confirmation number one. Then, of course, we get a retest of 521.36 as resistance this time around, and we get a rejection. That's confirmation number two, that we have a failure and the trade is on. We go down to 520, we have a fight, back and forth, and of course, the fight scares a lot of the 520 calls to close their positions and take the loss. Sure, we did close above 520, but the majority of holders of Friday's expiration walked away losers. And then we closed below 521.36 at the end of the day. Bottom line is, it wasn't really a good week for trading, but we managed to squeeze in some gains here and there. Now, we tie up the conversation back to the XLU. We go back to the morning brief. Using the 4 hours chart, we see severe overbought conditions on the RSI. I will try again to time a pullback trade on it by using the 70 puts for next week's expiration. And here's the chart that I gave you, 4 hours. You can see that it is extremely overbought. So when we say that we're betting on a pullback in the XLU, we're not saying that the message is wrong by the outperformance of utilities. We're just betting on a technical outcome, that it's overheated in the short run, and we see a pullback. But the message behind the rally in the XLU, I think that's well received. I think we got it. We know what the XLU is doing. It is warning about a possibility of a recession. Here's the update of the chart. You can see that we began forming perhaps a topping pattern. All what we need is just a little pullback and the trade will work out. And for all you know, the dip could be bought in the XLU and higher it goes again. Now, the outcome from the CPI will be pivotal to the XLU. Think about it this way. If we get hotter CPI, then bond yields will go higher in anticipation of the Fed perhaps hiking rates. Would that be good for dividend-paying utilities? I don't think so. So what are you saying, Maverick? Are you betting on the CPI coming out hotter? No. Let's think about it the other way. Let's say that the CPI comes out cooler than expectations, and we see bond yields going down. Now, you'd think that that's going to be good for utilities, but you got to remember this. CPI coming out cooler, bond yields going down. It means that rate cuts are back on. Okay, if rate cuts are back on, again, I think that rate cuts will only happen for the wrong reasons, but the market can play this game until that happens. But if we have rate cuts back on the table again because of a weaker CPI data, then wouldn't it be that we're going to see a rotation from risk off to risk on, and we see that chips, technology, comm services, cyclicals leading the market again, and we see a rotation out of defensive utilities? I think either way the XLU pulls back. At least that's my bet. We'll see what happens. Now, the other point I want to talk about is, of course, all eyes on the CPI. But you got to be careful that maybe we have a tunnel syndrome here. We're just concentrating on the CPI, but then the surprise comes from the PPI, or retail sales, or leading economic indicators, or the Philly Manufacturing Survey. We have plenty of data. It's the Super Bowl of macroeconomics data this week. And the surprise could come from a data point other than the CPI. But, as we said before, folks, we are in the risk management business. So, if your positioning is bullish ahead of the CPI or bearish, you gotta consider some hedging prior to the CPI data. And we utilize the most yield-sensitive ETFs for that. TLT, that's bonds, IWM, small caps, IYR, real estate, XHB, home builders, XBI, biotech. If we have a hotter CPI data, bond yields go higher. We're probably going to see all of them going down. And of course, if we have a hotter CPI data, we're probably going to see the dollar going higher. And we'll see precious metals, but specifically silver, going down. So this is why we're using those as a hedge. If you're heading into the CPI with mostly bullish positioning, you need to grab some puts in one of those at least. That way, if you lose in your main bet, you have something to compensate you at least for a portion of losses, and then you can manage and assess your position. Maybe you need a different strategy. But worst thing you can do is you go naked, and then the outcome from the CPI comes out against you, and you lose in your main bet, but you don't have any hedge against that. Likewise, if you're heading into the CPI with mostly bearish positioning, you gotta grab some calls, the TLT or the IWM, IYR, any of these that you see here. That way, if we have a cooler CPI data and the market goes higher, it will be led by these names. So you're gonna have some exposure to them, just in case your main bet loses, you have something to compensate you for that loss. We'll talk about this in details on Discord right before the CPI, so stick with us, folks. But right now, we're done with the market commentary. That's it, short and sweet. And of course, the macro coverage comes out tomorrow. But we're not done here, folks. We still have the market data to look at, and that's going to add more color to this conversation. Let's do that. We begin with the closing of the indices this Friday, and here we go. The diamonds closing in the green, up by 125.08 points, or a gain of 0.38%. The Nasdaq in the red, negative, beat flattish, down 5.40 points or a loss of 0.03%. The Spider in the green, but beat flattish too, up by about 8.60 points or a gain of 0.16%. The Russell 2000 yield-sensitive small caps leading the way to the downside, down by 1.55 points or a loss of 0.75 percentage point. Is there a message here from Russell 2000 underperforming just before the CPI? And then we see the 2-year going higher. I think there is some counter hedging that, wait a minute, maybe the action that we got for the week was a trap and it requires some hedging now that the VIX is trading at the lows. If we look at the sector's performances on Friday, we see that defensive leading the way at number 1, followed by technology and then financials. The laggards led by cyclicals, energy, and comm services. If we contrast this for the week, it was rebound week. So pretty much every sector of the market was in the green, with exception of cyclicals. I would say that Tesla has an impact in that. The name was down big for the week. We will talk about it in a minute, but the point being, utilities still leading the market for the week by far, up about 3.5%. That's a big gap from the about 2.5% gains in financials coming out number 2. If we contrast all of this with the 1-month performance of the sectors, you can see that utilities at number 1 by far, up almost 10%. Then comes defensive at number 2, up about 4.5%. What is the message here? The message is risk off, not risk on. The market is being really, really defensive. Of course, the counter will be, well, what about financials? I hear you. Financials to me is a mystery. I think that the managers just love to allocate assets into financials and the big banks. But I think if we have a recession and a bad outcome in the market, then financials is the last place you want to be in. If we look at the breadth of the market on Friday, we see that we're pretty much closed neutral in the NYSE, 45% advancing versus 53% declining. This is exactly what the market maker wants to see, a neutral closing on Friday. Not so neutral in the Nasdaq, though, was negative, 35% advancing versus 62% declining. If we look at Friday's heat map, what do we see here? Most sectors closing in the green, but we see a rebound in technology, specifically in chip names, NVIDIA, Taiwan, ARM, Broadcom. The rest of technology, not so hot, so we see most of the big caps down: Apple, Amazon, Google, Meta, Microsoft, flattish. And then we have plenty of software names going down, such as Shopify, adding to the pain from the report that came out the day prior. We see the banks doing okay. We see that defensive, staples, doing okay. But then you look at the other sectors, it is pretty much a mixed message across the board. Mixed performance in healthcare, in industrials, in energy, in metals, even in utilities on Friday's session. If we contrast this picture with the weekly picture, what do we see here? Mostly positive. Rebound, inclusive rebound across the board, but not led by the usual suspects here. You look at Apple down for the week. Amazon, Google, flattish. Sure, we got winners in Microsoft and Meta, but Meta was down big after earnings. NVIDIA, you'd think that name would be up big, but it is flattish, up a little bit, 1.25%. That's flattish from NVIDIA. But the pop in the market this week was led by value stocks. Whether we're talking about defensives, whether we're talking about healthcare, energy, metals, utilities, industrials, we see a pattern of the value names tending to outperform in these sectors. Now, the laggards of the week led by a lot of reports that came out, such as with Disney, Airbnb, Shopify, all of these names going down because of bad reports. At least this is how the market received them. And then we have the souffle Tesla down about 7% for the week. That's a massive drop and perhaps a reversal in the rebound that we got last week. We continue to get bad news from the souffle. For example, Elon Musk was bad-mouthing LiDAR technology as useless. And now, all of a sudden, we find out from Luminar's earnings that Tesla been quietly buying some LiDAR technology from the company. On top of that, we got the product launch chief quitting Tesla in bad-mouthing the coffee machines of the company because Elon is cheap and he's not providing good quality machines. We'll look at the chart. You'll see that it's not looking good, folks. But we'll do that in a minute. Before we do that, let's do the heat map for the ETFs. This is the weekly heat map, an inclusive rally for the most part. Of course, when you see the XBI biotech underperforming, you gotta wonder what is the message here. Biotech is yield sensitive. If yields are going down, we're supposed to see the XBI going higher. So in case this week we get a hotter CPI and we see that bond yields are going higher and the IWM is going down along with the IYR, real estate and home builders and the rest of them, we're going to look back and realize that the XBI was the leading indicator. But for the week there was. You can see that value, VTV, IWD, outperforming large cap growth and outperforming small caps. And this is, of course, coming from the outperformance of value sectors in the market, such as utilities, the XLU, consumer staples, XLP, metals, XLB. Even energy managed to outperform this week and trade positive in the XLE. All of these are value sectors, so we see VTV, IWD outperforming for the week. We also see a huge rebound in GDX gold miners, SLV silver, GLD gold. Now, could it be a trap, though? Because the GLD going higher along with SLV and gold miners, it is a bet that the dollar would go down. Why would the dollar go down? How about a cooler CPI data? What if the market's assumption is wrong, though? And this is why I say that this week might have provided a lot of traps. We'll see what happens, but we move on to commodities. This is the performance on Friday. We see that crude is down across the board. Matter of fact, all the energy down for the day. The RBOB down about a little over 1.5%. Heating oil down about 2%. And nat gas pulling back by about 2%. Is it a recession signal when we see gold higher, but we see energy down? We see utilities higher, but energy down, perhaps. And metals across the board on Friday were positive. Gold, platinum, palladium, now even copper was up about 1.5%, so not quite a recession signal from copper. But I've been saying that we have a stealth recovery in China. I think copper's outperformance is related to China, along with the incredible outperformance that we got the last session of the week by grains. You see massive gains for soybean oil, for corn, for wheat futures, all surging higher. If you grab a chart of the FXI, the Chinese technology sector, you'll see that it's been outperforming as of late. I think these two things are related. The outperformance of Chinese equities along with copper and, say, wheat futures. Here's the problem for the Fed. If the XLU is flashing a recession signal, but we have wheat and we have copper flashing a recovery in China, then wouldn't that be the epitome of stagflation? Something that the Fed needs to think about. And when we look at softs, what do we see here? Rebounds in cocoa, be it modest. And we see another rebound in OJ, up about 3%, but we see negative activities across the board, led by cotton and sugar futures down about a little over 1.5% apiece. When we look at the weekly performance for futures, what do we see here? Cocoa at number 1 again, followed by OJ, silver, wheat, oats, natural gas. So we see a little bit of inflation there. Although, perhaps more important than all of them, the gasoline RBOB down about 2% for the week. Of course, you see the Japanese yen down about 2%. We cannot ignore the yen story, folks. It could flare up any moment. Because I said this publicly. I said I promised the BOJ they will not rescue the yen without raising rates. You gotta raise rates. Problem is, if you raise rates, U.S. bond yields are gonna go higher. I mean, you've seen the auctions this week. They're not really pretty good. The 10 was awful. The 30 was a little better. But if we see Japanese yields going higher, you will see less demand on these auctions. And U.S. bond yields will have to go higher to compete with Japanese yields. And what does that mean? It means higher mortgage rates for longer. It means higher credit card rates for longer. And this is not good for the consumer. It causes a recession along the way, maybe. This is what utilities are seeing right now. We move on to the big casino, the options market. What do we see here on Friday? Volume moving a tick higher, but only for the two popular names, Tesla and Nvidia. The rest, the market was dead. A lot of traders decided not to get engaged this week. Low volume, mixed messages. We're better off waiting till we get the aftermath of the CPI data. Now, if we look at the flows, bullish flows, bearish flows. From Friday's session, we see bullish flows in Amazon, Nvidia, SPY, XLU, but we see bearish flows for Tesla, Alta, Roku, and many other names. Now, this data is from Options Strat, folks. If you want a discount, 25%, link in the description. And I'm looking at the buy flows only, not the sell, because this is what impacts the market maker. Now, some of the interesting trades that I found, let's begin with Amazon. This is a bullish trade, highly unusual. Somebody bought the 190 calls, the expiration date in September 2025. So somebody's betting that Amazon will trade higher all the way till 25, and they bet about over $1.5 million on that outcome. Now, looking at Amazon, it is the best looking chart in the mega cap technology stocks, and it is, of course, the best report that we got out of the mega cap technology stocks. How about this one for the XLU? Bullish trade, highly unusual. They bought the 63 calls, the expiration date January 17th, 2025. They sold the 82 calls for the same expiration date, paid about $5 million for that bet. The implications here that XLU would trade above 63. Matter of fact, for the trade to be profitable, it'll be above 72 by Jan 25, but it might not be quite as high as 82 or above by then. In other words, perhaps consolidation, chop from this point on. With that being said, a little higher by 25. When we look at the unusual bearish trades, what do we see here? How about Tesla long puts? Somebody bought the 210 and the 215 puts for the expiration date May 17th, meaning this upcoming week. Paid about $3.5 million for those. They're betting that Tesla will be below 162, 160 by the end of the week. And then we have another bearish one for Alta. Somebody bought a bunch of puts here with different expiration dates from June 21st all the way to September 20th, ranging from the 500 all the way to 550 puts. They spent about $5.5 million on those. Now, we talked before about the weakness in Ulta Beauty and the warnings that we've gotten from the company before. And this week, we got Elf Beauty. And again, we're seeing a slowdown on beauty consumption. So again, we have another sign of weakness in the consumer in this economy. If we look at other unusual activities, what do we see here? How about coin? C-O-I-N. Somebody's betting that Coinbase will go higher. Well, it wouldn't go higher without Bitcoin going higher, so I guess it is the same bet. But here we have somebody betting on the 212.5 calls for the expiration date this upcoming Friday, May 17th. The expectations. Coinbase will go higher and gain more than 6% by then. Paid about $3.20 a piece. Stellar. This trade, all in all, spending about $7 million. A lot of money being bet on Coinbase and MicroStrategy. I'd call them high roller tables because highly volatile can be highly rewarding, but you gotta bet a lot. And what happens if these stocks just stall for the week and the implied volatility goes down? Now you're losing either way. So you got to be really careful with assuming the risk here. Then we have the VXX. This is a VIX proxy. We bought calls on it this week. Maybe we're a little too early. And we might actually see volatility moving higher this week. Therefore, somebody bought the 14 calls for the expiration date June 7th. The expectations, the VXX will move higher and gain more than 16% by then. Paid about 30 cents a piece, tenor this trade. All in all, spending about $360,000. Now, we have a lot of trades for Novavax, NVAX. Look, the volatility is way too high. You're going to overpay for the premiums. Unless you know something, you better stay out of it. You can buy calls or buy puts and overpay for them. And next thing you know, Novavax just trades flattish for the week and you lose because of the drop in IV alone. But here's the last trade that we got for ARKKKKK for Tesla Witch, Kathy Wood. With a drop in Tesla stock, we're seeing a drop in the RKK too. Somebody betting it's going to get uglier. And they bought the 39 puts for the expiration date July 19th. The expectations, Mama Kathy Wood would go down and lose more than 9% of value by then. Paid about $1 a piece, tenor this trade, all in all, spending about $600,000. Let's do the charts and then wrap it up. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? Look at the RSI. It's been overbought for a while now, for a few days, but we've never seen a pullback. Why? We don't have volume. With a lack of macro, we have no volume in the market and no opposite opinion, no opposite bets. And this is why, yes, the market been waiting. Hey, anybody wants to pull us back? I'm ready. We're overbought in the hourly RSI, but nobody showed up. So the algos keep buying and the market maker had to buy Thursday. And we see the market going higher. Now, is it forming a bear flag pattern? I think so. And once the volume shows up, and it will show up prior to the PPI and CPI data, we will see the overbought conditions in the SPY in a correction, and we will see a pullback. Now, whatever pullback we get, when do we say that we have damage in the chart? When do we say that the bears are beginning to gain some momentum? Well, zooming into the 10 minutes chart, at least you got to break the positive trend line. And that wouldn't happen without the loss of 520. So that would be at least a confirmation, bearish confirmation in the really short run. On the daily chart, a little longer of a run here. We see that we got to the upper Bollinger Bands. We're finding some resistance at the upper Bollinger Bands. Of course, we have the last piece of resistance at around 523.87. What is the bull-bear line in the daily chart? I would say it is the 50 days moving average in blue at around 512. You trade below, the bears regaining the advantage. We stay up and above, the bulls still got the advantage. The weekly chart for the SPY, what do we see here? We got a nice rebound of the 20 weeks moving average, and now we're above the top of the breakdown candle, 515.30. That makes it the bull-bear line. Now this is a weekly closing, so it's going to take a weekly close before you have a confirmation. In the meantime, you got the confirmation lines on the short-run charts that we just gave you, and the daily charts, which is the 50 days moving average. But in the weekly, it is 515.30. We close below, the bears back in charge. We close above, the bulls still in charge. You look at the hourly chart for the E-mini futures, what do we see here? Bear flag? Sure. But would it do any damage if it plays out? It wouldn't do any damage unless we lose the bull-bear line, which is right now sitting at 5,170.25. So long as we're above, the bulls are still in charge. The bias remains to the upside. We go below, the bears are back in charge. You look at the Q's hourly chart, what do we have here? Gap and crab, bear flag pattern, sure. But any damage in this chart? No. What is notable though? The underperformance of the Q's versus the SPY. As if technology got a gap higher Monday, a little higher Tuesday, and then stalled, doing nothing at all till the end of the week. Question now becomes, is it waiting for a counter volume to show up so it can pull back? Or is it waiting for folks waiting in the sidelines, perhaps after the CPI, perhaps to have a certain degree of comfort that the CPI is out of the way, and then those on the sidelines jump in and we see the energy being released to the upside? That's what's important about this week in the Qs. We go to the daily chart. What is the confirmation line? 50 days moving average. We're trading above, the bulls still in charge. We close below that line. The bears have to be active again because the advantage is changing in their favor. On the weekly chart, what is the bull-bear line? It is the top of the breakdown candle, a little higher than the daily target of the bull-bear line, but this is a weekly chart. 442.15. So you can fluctuate in the daily chart and the hourly chart. At the end of the day, on the weekly chart, where did we close by the end of the week? Above or below? Above, bulls are in charge. Below, bears are in charge. For now, believe it or not, on the weekly chart, the bears are still in charge. And that could be a leading indicator that whatever rebound we got this week was just a trap, because on the larger scheme of things, the bears were still in charge in the Qs. On the daily chart for the NASDAQ futures, what is the bull-bear line? 17,735.75. We're trading above. The bulls are still in charge. You give them the benefit of the doubt that we have a bull flag pattern. And higher we go. We lose that line. And the bears must be active again, doubling down, opening new bets because the momentum is shifting in their favor. The small caps, IWM, hourly chart, what do we see here? Got a little bit of a rejection on Friday's session, maybe forming a bear flag pattern. But last Friday, we formed a bear flag pattern that did not play out. The message is you need to see a little more before you begin betting against the IWM, and maybe the PPI or CPI will give you that permission to do so. What we know for now is we have perhaps a double rejection. On the hourly chart, we have stiff resistance. We have a point at around, let's say, 206, where we see sellers showing up. If you look at the daily chart, could have been a bearish engulfing candle, but we didn't get it. So we don't have a bearish confirmation yet. What is the bull-bear line? It's the 50 days moving average. You trade below, bears back in charge. You stay above, bulls are in charge. Here's the warning sign, though, for the IWM. If we look at the weekly chart, what do we see here? If we stall at this point, and the IWM goes down and it loses the 20 weeks moving average, meaning a trade below 200. It'll be a confirmation of a topping head and shoulder, and down we go. That's only going to happen if we have a hotter CPI and yields go higher. If we look at the dollar daily chart, what do we see here? We got rejection at the 20 days moving average in white, but we still got support at the 50 days moving average in blue. Now the pattern is off a bear flag pattern. If the charts are leading indicators, as many of us believe, what's up with the bear flag pattern in the dollar? Is it warning that the CPI will come out cooler and the dollar is going to go down? At least this is what the chart is saying right now. What if the opposite happens though? Hence the trap. If you look at the vortex indicator, you'll notice that both the bearish and bullish momentum are gathering steam. Once again, the mixed messages from the week. If we look at the old man gold, what do we see here? Daily chart above the 20 days moving average, check mark. The MACD indicator about to reverse from bearish to bullish, check mark. The vortex indicator, bullish outweighing bearish, check mark. For now, you gotta assume that gold goes higher, unless of course we have a loss of the 20 days moving average. That's only gonna happen if the dollar goes higher. Why would the dollar go higher? The answer is a hotter CPI or PPI, hence the trap. Was gold just giving us a false sign that the dollar is going down? And next thing you know, the opposite happens? That could be a possibility. This is why you gotta be really, really careful with these kind of bets and these kind of signals that we get from a low volume week such as what we got this week. The GDX gold miners, what do we see here? We're stalling at the prior top. That's in or around 35.74. We close above, you got a bullish confirmation. If we stall here, I don't see the GDX being tradable because we're stuck in the range. If we break 32.43, then we have a bearish confirmation or we got a trade on it. But right now, if we stall here, I just don't see it. You look at the weekly chart for the GDX, 35.74 has been a point of rejection over and over and over again in the past. If we get a rejection again, and then we lose 32.43, understand that gold miners are going down, and that's going to be because gold is going down. Why would gold go down? Dollar going higher. Why would the dollar go higher? Hotter CPI data. Everything is connected here, folks. Then we look at the SLV silver, leading indicator for gold. What do we see here? We talked about the falling wedge pattern before the week even began. We talked about the possibility of an inverse head and shoulder. Well, we got a confirmation of that by closing above the 20 days moving average in white, but we stalled at closing the gap. Now we do have a confirmation, bullish confirmation in the vortex indicator with the blue line crossing above the red, bullish above bearish, but no confirmation yet in the MACD indicator. This is a really interesting phenomenon because usually we say that the MACD leads the vortex. Why do we see in this case, the vortex leading the MACD? The vortex cares more about the peaks and valleys of a certain trading session. And of course, we have a lot of gap ups in the SLV in this chart. On the other hand, the MACD cares about the volume. And this week was a low volume week. So we don't have the confirmation yet in the MACD. If we look at Brent oil, UK oil, what do we see here? The most important line is the 200 days moving average in yellow. We got a clear rejection of that Friday session. Could we see more downside in oil? The answer is that's the message that I got. And if that is the case, you tie it up to utilities. Do we have a recession sign in the economy? Now, of course, we have a flare-up in the war in Russia-Ukraine, and we have a flare-up in Israel-Gaza that could lead oil prices higher again. So we look at the weekly chart. We have a tension pattern. Lower highs and higher lows for now. Which side has the advantage? I would say downside because we lost the 20 weeks moving average. But that could reverse easily, and this is why this week is critical. If we see a pop in oil, and we see a closing above the 20 weeks moving average, then you gotta assume that we have a recovery ahead and oil is gonna surge higher. And perhaps market performance will be led by the energy sector again. But the other confirmation you need to see, so confirmation number one, closing above the 200 days moving average in UK oil or crude oil futures, whatever you like. Confirmation number two, closing above the 20 weeks moving average. Confirmation number three, ExxonMobil, usually the leading indicator for energy stocks. You gotta see it closing above the 20 days moving average in white. Now, if we get that confirmation, then you see that other energy stocks joining ExxonMobil. We're talking about the refiners, the Valeros, the Marathons. We're talking about other gas names. I know a lot of you want to buy the dips in the refiners such as Valero or Marathon, but you got to see these confirmations first, folks. If we look at the 10-year yield, what do we see here? Consolidating in a bear flag pattern. If the chart is a leading indicator, it is saying that maybe CPI will come out cooler and the bear flag will play out and the market will go higher. What if the opposite happens though? Then it gave us a false signal in a low volume week, and that's pretty much a trap. We look at yield-sensitive names. What do we see in the XHB? Home builders, weekly chart, what do we see? We got a rebound of the 20 weeks moving average. That's our bull to bear indicator. We're staying above, that's bullish. We're not going to be bearish and bet against it until we lose the 20 weeks moving average. And that could be, by the way, in an inverse ABC pattern, and that could be a really juicy trade. But we need to have a confirmation before we do that. You look at the IYR, real estate, it's the same thing. On the daily chart, we see a resistance point at the 50 days moving average in blue. Confirmation is short though. We have to go to the weekly chart. We have the 50 weeks moving average. That's the bull to bear line. We're staying above. you gotta be bullish. We lose it, we close below, you gotta switch back to the bearish side because we could be playing again an inverse ABC pattern. If we look at the KRE regional banks hourly chart, what do we see here? Could be a triple top, head and shoulder, stalling, who knows? Not an attractive chart for me to trade, to be honest with you. I know a lot of you want to trade it, but what is the point here? Zoom out to a weekly chart, and the KRE regional bank's been just consolidating since the year began. Nothing is going on. I don't understand why traders keep asking me about KRE. I just don't see the opportunity. I see folks continue to buy it from the institutional side, but all in all did not change anything on the weekly chart. We didn't get out of range yet. If we look at biotech XBI, what do we see here in the weekly chart? What is the bull to bear line? The bull line is the 20 weeks moving average. You close above, gotta go along the XBI. The bear line, 87.89. We close below that by the end of the week. You gotta take a shot against the XBI because this could be topping head and shoulder pattern. The volatility index, VIX, what is the important line here? The 20 weeks moving average. We're below. The bulls have the advantage. We're trading above and we're closing above. The bears back in charge. Big Kahuna Apple daily chart, what do we see here? Consolidating for the week, doing nothing at all. My guideline is if we lose the 200 days moving average in yellow, we're going long the 175 puts, expiration date TBD. If we close above 187, we're going with the 200 calls, once again expiration date TBD. Souffle Tesla hourly chart, what do we see here? We talked about the possibility of a falling wedge. We might get a pop out of it. We got that pop in the morning Friday, but it was short-lived as we got more bad news from the souffle. Now we're consolidating in a bear flag pattern. The bulls would argue, but Maverick, we have really oversold conditions in the RSI and the hourly. We gotta get a pop at least. I hear you. I'm with you, but you gotta look at the daily chart. We have significant damage here. We lost the 50 days moving average in blue. Next thing you know, if we close below the 20 days moving average in white, then we're gonna go down to closing the gap. That's gonna be a major drop for Tesla. You can see that the momentum in the MACD indicator is about to change from bullish to bearish. On the weekly chart, what do we see here? Got a rejection of the 20 weeks moving average. Then we got a confirmation of that. We closed below the gap, 172.12. This is a bearish sign in my view. Until what? Until we close above the 20 weeks moving average. Simple as that. We segue to NVIDIA. What do we see here? Hourly chart, nothing to see. We got a bear flag that didn't play out. Friday we got another one, but nothing really significant here. We'll keep the bull line as 860 or above. Got to stay bullish. The bears take advantage if we lose 824. Being a little more conservative here because I need to see a solid signal before we begin shorting the video. On the daily chart, what do we see here? We're above all of the moving averages, the 50 in blue, the 20 in white, so we got no signal at all to place some puts in the name. Another way we can look at it is a tension pattern. Lower highs, higher lows. Who has the advantage in the tension pattern? How about the bulls? You can look at it as a bull flag pattern. You can look at it as an inverse head and shoulder pattern. Before you begin shorting the video, even for a trade, put options, you gotta get somewhat of confirmation. At least loss of the 50 days moving average, if not the 20. At least losing 860, if not losing 824. And lastly, tulips, Bitcoin. But we begin with MSTR MicroStrategy. Now, ironically, Thursday I said, folks, I'm covering my short. I made about 17% plus, big profits. I see that maybe MicroStrategy is changing back to bullish. I don't want to take the risk, I cover. Next thing you know, MicroStrategy is down about 6%. Typical behavior by the market. I buy, stock drops the next day. I buy, aka cover my short, the stock drops the next day. You can't win. But let me clean up the chart for you and sell my argument a little bit on why being conservative, disciplined, careful, maybe a little better than being adventurous right now. Look at the daily MACD. Is it changing from bearish to bullish? Yes, it is. Can we still argue that this is a bull flag pattern in MicroStrategy? Yes, we can. When does that argument goes out of the window? The answer is if we lose, here it is, the red line, 1132. We trade below that gap, understand that we're going lower, and I can place my short again. No harm done. The other confirmation is, if we look at Bitcoin daily chart, what do we see here? Got a series of lower highs, lower lows, got it. But I need to see a loss of 59,224 again. That would be for me the confirmation that yes, Bitcoin is about to flush down, and with it, of course, the best bet in town would be shorting MicroStrategy. But again, until getting these confirmations, I'm happy with my decision. It was a huge bet. You guys know the amount. And I don't want to be cute with it. Made a lot of money in a short amount of time. That's what counts. And then if we see the trade back on, we can get back into it. No harm done. Let's move on to the conclusion of this video. What do we have in the economic calendar this week? Again, the Super Bowl of macro data. Monday, not a lot. We have a bunch of Fed zombies talking. Could be just a neutral day, a nothing burger day, but it's going to be a really good day for you to hedge and strategize for the upcoming events, because Tuesday, May 14th, we get the PPI right off the gate, Producer Price Index. And on top of that, the big zombie Powell, he's going to speak. And of course, all of this data leaks to him at a time. Why is this important? If Powell comes out dovish, what is he saying really? He's saying that Wednesday's CPI will actually be good for the Fed. Will come out cooler. In other words, Powell will give us the green light to buy. If Powell comes out hawkish, then he probably got the CPI data, and it's not going to come out good. And he's giving you a warning sign that we're probably going to go down. So Wednesday the 15th, here it is, the CPI, aka the CPLI. And then we have retail sales. On top of that, we got the Empire State Manufacturing Survey. After that comes the Home Builders Confidence Index on top of business inventories. And here he comes again, the demon from Minneapolis, Neil Kashkari. After the PPI and the CPI, if he comes out and says rate hike, oh boy. Thursday, 16th, we have initial jobless claims, comes on top of the Philly Fed Manufacturing Survey. And on top of that, we got housing starts, building permits, the Import Price Index, a really critical piece of data. And after that comes the industrial production data along with capacity utilization. And guess what? We have a bunch of other Fed zombies talking, from New York Fed Williams to Chair Barr to Cleveland Fed President Mister to Atlanta Fed zombie Bostic. So it's going to be as important as it gets. And we conclude with Friday, May 17th, options expiration. But on the macro data, we got leading economic indicators on top of Fed zombie Waller speaking. Can it get any more important than this, folks? I don't think so. So we have a lot ahead of us. Let's take a little bit of a rest and then catch up tomorrow. But with that, folks, if you enjoyed the show, please help us out here. Press the like button, subscribe, tell your friends, tell your family, tell your mistress that we're here. And consider being a member here on YouTube, or better yet, on Patreon. All of the links in the description. With that, folks, thank you for being with us tonight. This is all I got for you. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. Good night.
I do wish we could chat longer, but I'm having an old friend for dinner. Bye.